There's a $3.2 trillion cage, and two global superpowers are locked inside it. For years, we've been told a terrifying story. A story where one nation holds a financial weapon so powerful it could end American economic dominance in a single day. But that story is a complete fantasy. The weapon doesn't exist. What exists instead is a trap of mutual dependence so powerful, so inescapable, that neither side can make a move without destroying themselves in the process. This isn't a weapon, it's a financial cage. Let's start with the sheer scale of the holdings. China possesses an estimated $3.2 trillion in US dollar-denominated assets. This includes government debt, corporate bonds, cash reserves, and other financial instruments. That's a larger position than Japan, the UK, or the entire Eurozone combined. The common fear is simple. What if they decide to sell it all? The assumption is that such a massive sell-off would instantly crater the US dollar, send interest rates into the stratosphere, and trigger a deep American recession. It's portrayed as the ultimate financial doomsday device. But here's the secret they don't tell you. Launching that attack would be suicide for China. Think about the immediate consequences. If China dumps its US Treasury bonds and dollar reserves, the first thing that happens is the value of the dollar collapses on global markets. That sounds bad for America, and it is. But China is still holding the rest of its $3.2 trillion in dollar assets. If the dollar's value drops by 30%, China instantly incurs a loss of hundreds of billions of dollars on its remaining holdings. Their own central bank's balance sheet, which supports their currency, would face a catastrophic blow. This is the first layer of the trap. They would be destroying their own national savings. Now, let's look at their real economy. A significant portion of China's GDP is driven by exports, with the United States being a primary customer. If the dollar crashes and the US economy plunges into a crisis, American consumers stop buying Chinese goods. Demand vanishes. But it gets worse. A collapsing dollar would cause China's currency, the yuan, to surge in relative value. Chinese products would suddenly become 40 to 50% more expensive for American buyers. Their entire export engine, the foundation of their economic miracle, would seize up overnight. Factories would close. Unemployment would skyrocket. So, by pulling the trigger, they would be obliterating their own export market. Then there's the domestic debt bomb. Chinese corporations have borrowed trillions of dollars in international debt. Their revenue is in yuan, but their debt is in dollars. If the yuan surges in value, the real cost of repaying that dollar-denominated debt explodes. A 40% currency move makes their debt 40% more expensive to service. Widespread corporate defaults would be inevitable, sparking a massive banking crisis inside China. The government would be forced to print vast amounts of yuan to bail out the system, leading to runaway inflation. The very act of attacking the dollar would trigger a domestic economic meltdown. So, if they can't sell, what are they doing? They are executing a slow, decades-long escape plan. Their strategy has three pillars. First, they are aggressively buying gold, building a non-dollar reserve asset. Second, they are constructing alternative financial systems to bypass the dollar entirely. This includes their own international payment network, SIPs, and signing direct currency swap agreements with dozens of nations like Russia and Saudi Arabia. The goal is to settle trade in yuan, not dollars. But this shift is happening at a glacial pace. The third pillar is an internal economic rebalancing. China is trying to pivot from an export-driven economy to one fueled by its own domestic consumption. If Chinese citizens buy more of what China produces, the need for export dollars diminishes. This has been a stated goal for over a decade, and there has been some progress. But it creates a new problem. As Chinese wages rise, their exports become less competitive on the global stage. Their trade surplus is already shrinking, meaning fewer new dollars are flowing in. However, this does nothing to solve the problem of the $3.2 trillion they already hold. They are stuck with a massive stock of assets they can't offload without causing a disaster. This creates a terrifying standoff. The United States is also trapped. American policymakers know China holds this massive stake. So the US cannot use the full force of its financial weapons against China like it did against Russia. Freezing China's assets would be an act of war that would force China to dump its holdings, triggering mutual annihilation. So US policy is constrained. This mutual deterrence is the cage. Two giants holding each other hostage. Now we arrive at the race against time. China's slow diversification will take 20 to 30 years to complete. But the US dollar is facing its own internal pressures from soaring national debt and persistent inflation. The dollar's share of global reserves is steadily declining. What happens if the dollar system weakens from within before China can finish its escape? If the dollar stumbles on its own, China's $3.2 trillion in holdings would suffer catastrophic losses anyway. They are trying to get out of the cage before the entire room collapses on them. This leaves us with three possible futures. The first is an orderly, managed transition to a multi-currency world, which is optimistic but unlikely. The second is a crisis-driven collapse, sparked by a geopolitical event or a debt ceiling breach, leading to a chaotic global depression. This is, unfortunately, a high-probability scenario. The third is the trap simply imploding under its own weight, where the dollar's internal decay causes a collapse that devastates both nations simultaneously. In this final scenario, there are no winners. For 40 years, this relationship was a win-win. America got cheap goods and easy financing. China industrialized and lifted millions from poverty. But the very mechanism of that success has become a prison for both. The $3.2 trillion isn't a weapon to be feared. It's a symbol of an unstable and interdependent global system that is slowly unraveling. Understanding this trap is crucial, not to pick a side, but to see the real forces that will shape your financial future. If you want to follow this story as it develops, make sure to like this video and follow the channel Winds of Thought for more clear-eyed analysis. The next decade will decide how this cage finally breaks open.